Ben, welcome to Questioning the Manager. So let's start with the recently released Henderson Dividend Index monitor. Have you been noticing any interesting trends?
So the most positive trend coming from the monitor is that the underlying dividend growth from around the world in the third quarter of this year was 9%. That was slightly hidden for a headline level because the index is in dollars, so the dollar's been very strong, so the headline figure is more like 2%, but underlying it's very strong. It's being driven largely by the US, which saw 20% growth, and within that underlying about 10, so there's some special dividends there. But also places like Japan are very strong. We're starting to see some improved growth, from Korea and from Europe. But probably the most, I guess the other trend within there was that the Chinese dividends fell for the first time since we started recording the index in 2009. And in resources is probably the other big trend. Within the US, for example, the only sector that had a big fall was the resources sector. So oil and mining and minerals are seeing quite big dividend cuts.
Okay, so you say the US economy is looking strong. How are you tapping into this strength?
Yeah, so the, Hint has 43% of its assets invested in the United States, so it's the biggest country weighting by quite a long way. We have various investments there, ranging from things like a US REIT, so a real estate investment trust that deals with shopping malls, which is benefiting from improved consumer trends there. And also at the same time, we've got companies like some of the financials like JP Morgan, Cisco, which I think, to be fair, are some of the the very high quality companies trading at multiples that are very cheap. So we see a lot of opportunity there, not just because of the earnings and the dividend growth, but partly because the parts of the market are trading cheaply.
There's an interesting thing with a lot of companies seem to be buying back their shares. Is this a sign of confidence?
The interest rates are very low at the moment, and so it's very accretive. So it improves earnings significantly buying back shares, even if you do it with debt. So I think maybe that it is partly a function of very low interest rates that this is happening, rather than any particular view on the economies. I think what you are seeing is a lot of cash generation by companies, and that's partly because there's a lot of spare capacity at the moment, so the need for capital investment is lower perhaps than it has been at other times in different cycles. So companies are generating a lot of cash. A lot of the technology companies are generating phenomenal amounts of cash. So buying back shares, for them is a reasonable thing to do.
Okay, finally, Ben, in recent years we've seen a lot of dividend growth. Do you think there's room for this to continue, and if so, where are you finding it?
Yeah, I think the outlook for dividend growth is still good. We are forecasting growth to be a little bit less next year than this. That's partly due to that resource sector that I was talking about earlier. It's harder to see oil and gas and mining companies increasing dividends, and you probably still will see cuts around the world. But in general, the financial sector is still kind of normalising dividends from when they cut during the crisis. We're seeing sectors like the pharmaceutical sector, the consumer goods sector, they're all producing good growth, lots of cash. And so I think at a headline level, particularly from developed markets, we're going to see good dividend growth.
Ben, thank you.